Ahead and start talking through this. So before we get to the valuation, let's go ahead and talk through the EIC. So as part of your assignment that you turned in, let's start with the E in the EIC. And this was the data for Kroger and its corresponding betas. So what did you say about economic sensitivity in your homework?
Less sensitive in the market.
Okay, because you used what point, the 0.61?
Less than
Okay. And less sensitive than the grocery store industry of 0.7. Okay. And again, just intuitively, does that make sense? I mean, pretty much, why would they have a low beta?
People always need food.
Yeah, it doesn't matter if it's a recession. They're kind of staples and they sell kind of the food people eat every day. So they're probably going to shop there regardless. So that makes them less sensitive to changes in the economy. And that's really the point. So if we think about our Excel valuation model that you just worked on, then what it probably means is you're not going to see a lot of, cyclicality amongst the business. It's going to be more stable over time, which is why we're doing the E and the EIC. Okay. Now for the I, is this an attractive industry? So you should have referred to the industry spread. And what's the answer here? This should have been the spread that you submitted. Is this an attractive industry?
Yes.
Yeah, because it has an operating ROIC right now of about 9%, 8.97, against a WACC of about 6.07. Right, so it is definitely an attractive industry. Right, so at the industry level, the point now is to do a 5 forces. And the idea is for buyer power, supplier power, substitutes, barriers to entry and exit, and rivalry, we want to explain primarily why is it an attractive industry today. Like what makes it an attractive industry. So given those forces, what would you say? What would be some of the things? Yeah.
High barriers to entry and they're
Okay, so higher barriers to entry. What do you think? Why are the barriers to entry high? What do you think about that?
like the kinds of logistical chains you need to have to run a grocery operation, like that requires having set contracts, and those contracts are kind of rigid.
Okay, so the logistics scale makes it hard for a startup grocery store to get national scale. I also think that there's barriers to entry with the suppliers themselves. Meaning, if you want national brands, then you kind of need to have the scale to work with them, and they're going to want to work with you. So to some degree, there is some barrier to getting Procter & Gamble and Kellogg and some of the other companies to kind of give you the scale you need for good costs and pricing. Okay, so barriers to entry probably help this industry, which is why we don't see 50 different grocery stores, especially at the national level. What else could lead to a positive spread? Which of the other forces could be helping the positive spread? Yep. Well, right now, industry revenue growth is pretty low. It's like 1-2%. So how does that, which force does that play into? That's helping the spread. And while he thinks about this one, let me just take a quick survey. So how many people have been to a grocery store in the last 30 days? Just by show of hands. How many people have been to more than one grocery store, meaning a different one, not the same one, in the last 30 days? So most of you, when you went to grocery stores, you went to the same one on a recurring basis. Is that a true or false statement? Like, do you tend to go to the same grocery store over time?
For me, I've actually, so there's like the substitution aspect where it's like I actually go to Costco a lot when I go with my family because I like to buy bulk and like it's a wholesaler, and like I think a lot of people are finding that as a substitute good for.
Fair enough, but when you go to a regular grocery store, who do you go? Safeway, Giant, Safeway? Do you keep going to the same Safeway?
Yes.
Okay, because that would be the interesting thing, which is, and I don't have data on this, but this is where some kind of anecdotal data might be helpful to explain this. But I think that if we think about buyer power, I think we don't seem to exercise our buyer power because I think traditional grocery stores have a convenience factor, meaning people tend to go to the grocery stores that's kind of close to them, and they tend to go to that grocery store conveniently on a regular basis. So it's not like they're going to wake up and say, okay, well, today milk is 50 cents off and the grocery store 15 miles away, so that's the one I'm going to go to. Okay, I'm not saying that people don't look for sales at their existing grocery store, but given a similarity of costs and prices across the stores that they're in, okay, I think it's, yeah, then I think that the convenience factor tends to mitigate the amount of buyer power that we are exercising, and people tend to be loyal to their grocery stores because of that in today's environment, which helps them, even though it's a low price, as long as they have reasonably low prices, that people will continue to go to that store. And I think that kind of mitigates the rivalry and intensity of the rivalry amongst the stores. All right, today. All right, now there could be some, cross examples of rivalry that you mentioned, but I think that tends to explain why the industry has a little bit higher spread today, even in a tough business. All right, what about substitutes? What are the substitutes for grocery stores? And are they hurting the grocery stores? You mentioned Costco. Is Costco a rival or is Costco a substitute?
I think it's a substitute.
Okay, why do you call it a substitute?
Well, it's a wholesaler. I mean, I think in general there's like different. It's the same goods, but they're packaged differently, and there's like different.
Sorry, he's trying to fix the computers in the room.
Different purposes of going to each, if that makes sense.
Okay.
So, again, like larger families such as mine, there's 5, 6 people, and like there's 4 guys.
Mhm.
You just go to Costco now instead of buying in bulk and giant.
Okay, but if you define Costco and buying bulk like the super centers, then that's a potential substitute, which is probably hurting a little bit.
Yeah.
Who are the other substitutes for grocery stores today? All right, to some degree, your Targets and maybe even your Walmarts. And are they impacting profitability? Probably a little bit. What about online? Okay, what about fast casual? Because one of the alternatives to cooking is kind of, going to get a fast casual meal yourself and having it done for you, so you need to go to grocery stores less. And or increasingly these meal at home services like Blue Apron, etc., and potential delivery. So the point is, are these services and alternatives really hurting this industry today? And if we're looking specifically at the data in front of us on the screen, is it hurting the industry today? It doesn't appear to be. So as I said, what we want to do is explain why does this industry have a positive spread given the 5 forces. And I think that the primary forces are that the buyers are not exhibiting a lot of their power, right? Because to some degree, convenience is kind of overwhelming that for a lot of us. And as long as they're reasonably priced, people tend to go to the things that are convenient for them. I think supplier power is interesting because suppliers work both ways. On the one hand, the grocery stores need the big suppliers, but the flip side is, what's the one thing that the grocery stores have that the suppliers need even more? What do they really control? Shelf space. And there's a limited amount of shelf space. And to some degree, the grocery stores play that off the suppliers and say, look, if you want to be in all of our stores nationwide, you got to cut us a deal. And to some degrees, they can play that against the suppliers to say, hey, we got four products we'll have. There's 6 of you, give us the best terms. So in a way, I don't think the suppliers have a lot of power that they've been exhibiting over the grocery stores, and that has tended to help the grocery stores because of the limited amount of shelf space. All right. I think that, as people said, the barriers to entry are actually relatively high to build a national grocery store chain. You're seeing that. And as a result, there's not a huge amount of rivalry. Like it's price rivalry, but it's not overly intense to the point that it's cutthroat and they're not making any money. And that's today. But what really matters is 5 years from now. Like, what's going to change in those forces that's going to affect our view of the industry spread in the 5 years? Do you think any of those forces are going to change? And if so, which ones? So what do you think? Which of those forces are going to change in the next 5 years? Yeah.
Maybe like substitute with online.
Okay, so substitutes become more viable in online, and companies like Amazon going in and offering sort of home delivery of grocery store, by the way, completely changes the buyer dynamic, because now the convenience factor isn't how far you have to travel to the grocery store. To some degree, the grocery store is coming to you, and that could actually change the view of buyer power reduce the amount of barriers that substitutes have, and to some degree increase the rivalry in the industry. So that's probably a trend that would hurt the industry spread over time. And I think technology and the disruption of delivery is something that could impact the grocery stores in a negative way. All right, now how much? Again, we could have different point of views, but that would be what I'd expect you to do as part of your valuation. This is what would carry over into some of the assumptions you make in your valuation. Okay, is your point of view on this impact it would have on the industry. Okay, I also think that this, in a way, technology lowers the barriers to entry. That's why you're starting to see some upstart companies like a Blue Apron that may not have been able to work 10 years ago that can work now because it is lower cost to get to your home. And that is a trend that the grocery stores are going to have to deal with. And that means more competition. And more competition from the price clubs, the BJ's, the Costco's, which are being much more aggressive at getting into the food business as opposed to their traditional goods. So again, if we put this all together, what it suggests is that a toughening of those forces is probably going to reduce the spread of this industry in 5 years, right? Which then leads to the next question. Does Kroger have competitive advantage today? Given the data that we see and our definition we're using in this class.
Yes.
Okay, yes, slight. So the question then becomes, in 5 years, are they still going to have competitive advantage? Meaning, is Kroger going to go down because the industry is going to go down, but they'll still be doing better than the industry? Is the industry going to go down, but Kroger is going to stay the same? Is Kroger actually going to get worse off than the rest of the industry? What's your view about Kroger? Now we're talking specifically about them, as we talked about our future forces. Yeah.
I said them building their advantage.
Okay.
Doing like a lot of acquisitions.
All right. So Kroger's doing some acquisitions. What else is Kroger investing in? Did anybody look at BICO when you did your analysis? Did anybody read the IBIS report? What did BICO say? Or IBIS?
Oh yeah, Ivan's.
About Kroger.
They were just talking. I'm really looking for the industry, your industry. Just talking about how like the other competitors and
The other competitors are what?
the other competitors, such as Safeway, but it was like group underneath another thing. Oh, that owned Safeway, Giant, Stop and Shop. So that was really curious.
Okay. So to some degree, the consolidation is helping the industry because there's less competition. And Kroger individually has been buying up other grocery stores to get bigger. And I think that is probably helping Kroger maintain a little bit of an advantage because they are going to basically have an economy of scale, be one of the bigger players of the industry. And that's not going to change in the next 5 years. Right? So unfortunately, I got kicked out of Bloomberg. So trying to log back in. But again, if anybody read through BICO, and I'd strongly recommend you do this, particularly in any of your assignments going forward or the group project, look at what the analysts are saying, look at what the companies are telling them. Let's log in here. Theoretically log in. All right, I'll take a second. But what BICO says about Kroger is that Kroger has spent a lot of money investing in reworking 20 to 30% of their stores, in investing in data and analytics, investing in sort of distribution technology so that they can actually get into the types of things that Amazon is able to do, that Walmart is able to do. Kroger is actually not standing still, and they're making heavy investments. So if you didn't put that in your competitive advantage, then you have a flawed competitive advantage discussion of Kroger. Okay, so it's not just enough to say that Kroger is going to have a percentage value higher or lower. You actually have to give some supporting data and information about that. And so what Kroger's been saying is that they're spending huge amounts of money to basically rework their stores, build IT capability, build data analytics capability, build distribution capability in order to kind of go where the market is moving. That suggests that Kroger is probably investing in the things that are going to help them maintain their competitive advantage over their peers on a go-forward basis. Okay, so they're going to be one of the largest players in the industry with their sales, over $100 billion in revenue. Okay, so they're going to maintain economies of scale. Fortunately, Bloomberg is continuing to get problems today. They're going to basically be spending a lot of money on where the market is going in the future, and so that would suggest that they're going to maintain their competitive advantage. Okay, so in the interest of time, let's move on to the next piece, which is the historical analysis. So this is CFI. What did you say were some of the key things about the CFI? Historical 5 years. What were some of the insights that you noticed about their CFI? Yeah.
Pretty much each year they've been investing more than depreciation.
Okay, so pretty high rates of reinvestment. Did anybody do an average over the 5 years? I think it works out to be mid 80s, like 84, 85%. So basically they've had inconsistent free cash flow. 938.6 to negative 1.4 billion to 1.1 billion to 595 to 237. And it's not because of their gross cash flow. They've had consistent profitability. Challenges their reinvestment has been kind of spiking, and particularly the last couple of years, a huge amount of capex and increasing investment rates from 73 to 83 to 91%. And that's in combination with acquisitions. They've had an increase in intangibles all 5 years. So that goes back to the consolidation and the fact that they've been aggressively buying. If this is your group project, you should be identifying who those acquisitions are, which grocery store chains that they've been buying, but they've basically been making huge investments. And so that gives them very little free cash flow, particularly the last couple of years. All right. Now, what can we say about their non-operating cash flows? Anything big happening in the non-operating category? I mean, except for the increase in couple of increases and decreases in non-operating assets, nothing really substantial is changing in there. So what about debt and equity? What do we notice about debt and equity for Kroger? Increasing what? Yeah, they've issued about $8 billion worth of debt over the last 5 years. So they pretty much heavily financed by debt. Now what's interesting is they've actually had positive free cash flow over the 5 years. So why do they issue $8 billion worth of new debt? Yeah.
Dividends and share repurchase.
They've had an increasing dividend, which started at 267 million, went up to 429, and they've bought back consistently shares of a rate of 2 billion, almost 2.1 billion last year, $1 billion the year before, $1.1 billion the year before, $1.5 billion the year before. So basically what they're doing is they're issuing debt to buy back the stock and to some degree support the dividends. So number one, choice to capital structure. So that's probably not going to continue into the far future. Matter of fact, if you saw what happened with GE today, that was actually one of GE's problems, is they don't actually have the cash flow to support the dividend. And the bank said, we're not going to continue to lending you money into the tough industries you're in. So GE cut their dividend in half today and freaked out the marketplace. So long story short, Kroger's not at that point yet, but nonetheless, we got some warning signs on the horizon which suggest that, hey, toughening industry going forward, already low margins, no growth. They're borrowing heavily to buy back their stock and pay out a dividend, and they're making huge investments in their infrastructure in an industry that's not growing. Those are some of the trends that we're seeing in the CFI. What about the ROIC tree? What did we notice about their ROIC tree? What popped up here in Kroger's ROIC tree historically? How do we do this analysis? Is the ROIC getting better or worse over the last 5 years? Getting worse. It went from 10.3 to 8.6, 17% drop. Why? Was it the tax rate? Tax rate helped them. Was it the margin? Did the margin help or hurt them? Helped. So really, it was the pre-tax ROIC declining because it was the whack to productivity that they had. Their productivity got a lot worse. And we can see that with the invested capital to sales going from 18.2 to 23.3. Okay, essentially a 29% decline in productivity. What was second level? What was the main reason for that decline in productivity? Yeah. The intangible sales went up. Now, here's the thing. Even though it went up 157%, it went from a little number to a slightly bigger little number. So the real increase was actually in PP&E. So it was PP&E and intangibles, but PP&E was actually a bigger hit to their productivity, going from 15.4 to 18.2 versus intangibles 1.4 to 3.6 in pure magnitude. But regardless, it was all of that investment that we saw in the CFI, that 84% reinvestment rate over time, and the heavy acquisitions that they've made. So here's the thing. If you spend a huge amount of money and your sales don't change, that's going to hurt your productivity. And that's really the challenge that not only Kroger's facing, but I think it's symptomatic of what we talked about in the EIC that the whole industry is having to address, is that basically they're making huge investments, but they're not growing sales, and they're not really growing profits. So what does that really mean? What's the financial challenge in the future going to be? Lower what? Investments up, sales and profits don't change. What's going to go down?
Investments.
ROIC. Either they slow the investments to maintain their ROIC, or they're investing in an industry that's not growing, which is putting pressure on ROIC. So if you go back to the EIC, if this trend just fast forwards itself another 5 years, that's why we're kind of saying, we're already seeing in the last 5 years, the things that suggest that Kroger is going to have a lower spread in 5 more years. And it's going to be a challenging time for the grocery store industry. And there is no catalyst that anything about this is going to dramatically change in the next 5 years. So this kind of makes me, at least as I've now talked about it 3 times today, kind of bearish on the grocery store industry, right? That there's not really good trends for Kroger. These are very tough trends for Kroger because it's not like this market is growing at 5 to 6% a year. This market, according to IBIS World, is growing at 1% a year. And that's going to be the problem. You're spending a huge amount of money to basically not sell any more things at a low margin. It's going to put pressure on your business. And that's what we're already seeing has been happening to Kroger the last few years. So, valuation. You guys were actually asked to do an as-is valuation. I am guessing that your numbers look something like this. That we know tax rate, I put in 33, but somewhere around 32 to 33%. We didn't find a tax rate in their last conference call, but if we looked historically, it's been pretty consistent. So somewhere around 32, 33 is probably what you put in for your tax rate. Based on the trading multiples, you should have gotten an EBIT margin of about 2.6% in perpetuity. Okay, based on the trading multiples, which means on the ratios, this number should be around 2.6%, which it already is at the EBITDA of 4.6. So basically, the EBITDA is going to stay about the same as the 2019 analyst EBITDA. And if we look at an industry growing at around 1% a year in IBIS world, if Kroger's growing about 1% in the interim, 1.5%, and about a 1% G, then that works out to a 22.42 share price, which was very close to their actual share price today. Okay, so basically tepid growth, constant margins, and that leads to an explanation of the share price. All right, except here's what's interesting. In order to get that share price, I had to make a G of 1%. Yet I actually asked you to estimate what the G would be. So did anybody use the process we defined in class to estimate the G? What'd you get?
I got it was
It was negative, right?
I think I got negative 0.34.
Negative 4%? 3.4?
Negative 0.34.
Negative 0.34. So let's put that in. Okay.
My value for TV, no tax difference.
Okay. So given this one, it's actually going to be more like negative 5%. Right? So here's the thing. If we use the G based on the multiples into perpetuity, we're looking at some negative G, which suggests that the market does believe in perpetuity, that Kroger is going to have some challenges. What's interesting, though, is if we do use a negative G that's more realistic to the multiple, that's a share price of about $16. And in order to get to a $22 share price, we need to actually have much better margins and or much higher growth rate in the next few years in an industry that's not growing. And so where I thought Kroger would be a simple example of a steady state company, it's actually an interesting example of a complex issue. And I think what's happening here, and this happens from time to time, is there's a difference between the buy and the sell side. Meaning the sell side analysts have assumptions out there, which we're putting into our model, but they don't explain the trading multiple of Kroger. And that's the problem, is that if you look at the industry growing about 1%, then 1% growth makes sense. If you look at the margins, constant margins, and you look at a tax rate, constant tax rate, well, basically what it suggests is that Kroger would be at 22, but they're not at 22, because if we put in the G that the multiples are at, the G is down to 16%. Or $16 a share, $15, $16 a share. So how do we get closer to that G without making a negative 5% growth rate into perpetuity? Anybody have any thoughts on this? Because I've had a couple classes to think about this. And here is my thought. And I would have expected that you would have uncovered this issue if it were a group project. Because I would definitely be asking you this if I were sitting on your side of the table and I was looking at this data. Because I would see on your screen the EV to EBITs didn't match if you made G somewhere around 1 to 1.5% to get close to the share price. And I'd say, why did you use that G? And then how do you explain and reconcile this? So here's the deal. Everything we've done so far to simplify things for you, I've said leave the balance sheet alone. Because the idea is that if we leave everything on the balance sheet as a percentage of sales, all those ratios are a percentage of sales, then as the company grows, the balance sheet grows. So what's been implied in every valuation to date is constant productivity. Is that what's actually happening to Kroger? Is Kroger having constant productivity? No. We even saw it in the CFI analysis. We saw it in the ROIC tree that Kroger is making heavy reinvestments, including acquisitions, which suggests their productivity is worsening, which suggests that what is worsening? ROIC. So here's the thing. If this ROIC in continuing value wasn't 7.5%, but it was more like 4% or 3%, then we actually get closer to the EV to EBIT. In fact, 1.5% growth at a 4% ROIC is very close to the EV to EBIT. So here's what I think the market is actually doing. The way they're pricing the stock, and I don't think all the analysts have yet forecasted this in Bloomberg today, is that market is actually pricing them, not if their margins isn't changing, but if their ROIC is going down. Because they're making heavy investments in an industry that's not growing for reasons that we just talked about in EIC, and they're pricing their perpetuity not just at a low margin, but increasing investments, because that's the point. They're making huge investments, but their sales aren't changing. It's going to put pressure on their ROIC. And in order to keep up with the technology, the data, the direct-to-consumer logistics that need to be done, they're going to have to make a lot of investments. And so I think what the market is doing is they're predicting a lower ROIC. That's why the EV to EBIT is different. And what it suggests is what we haven't changed is the balance sheet, and that's what we would need to change. What we would need to do is we would need to go in here to the ratios, and things like PP&E, net fixed assets, as a percentage of sales, it's already been trending upward, trended upward even further. And that would start to take care of this. So in the past, I've said leave the balance sheet alone, and the idea of leaving the balance sheet alone was constant productivity. But what we're not seeing is constant productivity with Kroger. What we're seeing with Kroger is worsening productivity. And I think it's going to get even worse in the future. And that's the one thing that we didn't change in our balance sheet. So it does make it a little bit more complex. But if we were really valuing Kroger, this is a chance to actually change more than just the 4 variables. And we should change the PP&E to sales. So instead of 18%, it might end up being 20 or 21% getting ROIC closer to the 5, 6, 7 that it needs to be, as opposed to 8, 9, 10, which is where it was historically. So that would also change the valuation of the company. So again, in the interest of time, I'm just going to highlight that, but that's actually what we're uncovering with Kroger. All right, so where do you think, just to cut to the chase, where do you think they're going to be in terms of their target? Are they a buy? Are they a sell? Are they a hold? Where'd you guys end up? Yep.
I'd say they're more of a seller or hold, definitely not a buy, just from what I was looking at. It was just I had to make some pretty generous assumptions in the bull model to get them up to a higher price. So like especially like a higher growth rate. Just I mean, even with the number that you used, it was a pretty negative growth rate. So, I mean, it wasn't double digits, but still, it's not looking too good for the industry as a whole.
Yeah. What I'm saying is if we just shortcut all of that by making this continuing value ROIC 4 or 5% versus the one it was in the model with constant productivity, notice what that does to the share price as we get closer to the trading multiple long term. So therefore, what it suggests is sell. I'm actually on the sell side. I would say not that they're necessarily going to drop to 15 tomorrow, but I'm more bearish on this industry. And I think that's the way the market is pricing them. So I would put them in the sell category. Now, interestingly, you could call that a hold and say, okay, they're going to figure it out, and then they're going to rationalize their investment so that they don't keep scaling up and hurting their productivity, and they'll adjust and or find ways to get more sales or improve by slashing the number of stores and go direct to consumer. That could be the hold or the buy. And to some degree, if you look at the real world, well, can't look at the real world. The analysts were, I want to say, something like 8 buys, 10 holds, and 2 sells when I looked at it this morning. So the analysts are mostly in the hold, but there were a couple sells, and there were some more buys, but I think that the analysts are going to increasingly turn bearish on Kroger over time. And I think that's going to be their challenge. All right, questions about any of this? All right, here's the last thing that we need to adjust to our models. Okay, I'm going to try and do it really quick. In the DCF tab, we calculate an enterprise value in our model using the Modigliani-Miller-McKinsey approach, but Bloomberg and Wall Street actually calculate enterprise value slightly differently. If I was actually in the terminal right now, which I've been locked out of, it would say that Bloomberg calculates enterprise value as debt and equity minus all cash. So net debt plus equity is the actual calculation that they use. Our calculation is just debt plus equity. Okay, so if I'm going to compare the multiples of the model with the multiples in the real world, I need to have what I call a Bloomberg equivalent enterprise value. Here's how we sync them up. In your model, you take enterprise value and then you subtract all cash. Because in the real world, they don't distinguish between operating cash and excess cash. So go to the balance sheet, go to 2017, subtract operating cash, and subtract excess cash. This is what I will call the Bloomberg equivalent enterprise value. So just using the way they calculate it versus the more theoretical way of calculating it. Here's why. Then I want you to go to the multiples tab. Add a column, insert row 1, and these are going to be called implied multiples. If I can spell multiples. All right, so EV to sales in our model. Right now, EV Bloomberg EV, divided by sales, off the income tab, 2019 sales. EV to EBITDA, off the enterprise DCF, divided by income, EV to 2009 EBITDA, and EV to EBIT equals Bloomberg enterprise value divided by income 2019 EBIT. So this is your sanity check for your valuation. So the idea is a $15 share price is a 23-cent EV to EBIT. A $15 share price is an EV to EBIT of 9. So I made a series of assumptions in my model. I just want to sanity test them with the real world. So what I do is I say, is 0.23 based on companies out in the real world a reasonable multiple? And the answer is yes, because there's several companies trading at 23 or lower. Is 9 a reasonable multiple for EV to EBIT? Well, potentially, because Super Value is trading at 8.3 times EV to EBIT. So in my sell range, I just use the real world multiples as a way to say, you know what? They actually could trade at 9 times EBIT. They could trade at 23 times, 0.23 times sales. And that is not an unreasonable valuation, whether I'm thinking about my bear scenario or whether I'm thinking about my target scenario. Here's the opposite end of this. Let's say I had come up with a continuing value ROIC of 14% and a G of 4% and a $77 share price for Kroger. And I convinced myself, for whatever reason, that I thought this was reasonable. Look what happens to these multiples. That would be an EV to sales of 0.68. Does that look reasonable? That would be an EV to EBIT of 26. Does that look reasonable? No. So I don't think they're going to be trading at that share price anytime soon. So that's what I'm saying is we're using the implied multiples when we get to our target share price, even when we do our bull or bear range, to say, is this reasonable given the range that we're seeing out in the industry? And if we have a big outlier, then we just have to go back and test our assumptions, because we're probably making some assumptions that may not be reasonable based on what's going on in the real world. It's just a way of doing a sanity check. Okay, that's also going to be a requirement for your group project. So you'll start your group project with, here's my company, here's my target share price, buy, sell, or hold. You'll go through the 4 steps. When you finish up the valuation, you'll then finish it up with a sanity check, which is here's why I think it's reasonable, because here would be the trading multiples given my target share price, and here's why I think it's reasonable. By definition, if you're a hold, you're reasonable. This is really more if you're a buy or a sell, because you don't want to go too far into a range that probably wouldn't be realistic. Make sense? Okay, last thing, in the interest of time. For Monday, you'll consider this good news, bad news. It depends. For Monday is our last homework assignment of the semester, homework 12. It's going to do a week from today, Monday before Thanksgiving. I'm going to add 2 points of extra credit to the assignment. So it's worth 4 points, not 2 points. And it's a group project. So your same project group, you're going to work on the assignment as a group, and you're going to turn it in as a group. Okay? So that's the assignment for next Monday, worth 4 points of your semester grade. Now, if you don't participate in the group project and your group says you didn't, you'll get a 0. Okay, so you have to work with your group with the same groups. Here's the thing. Today, the headline was all about GE. It was on their dividend cut. So the company is GE. But here's how the project is expanding. You're going to do all 4 sections for next Monday. You're going to do an EIC. You're going to do a historical. You're going to do a valuation, bull bear, as well as is target, and you're going to do a multiples assessment of GE and its peers. Okay, and all of that will be turned in by next Monday, and then next Monday we'll discuss GE in class. So it's really a dry run for your group project. Minimum 1,000-word paper, right? Plus all of the exhibits. So it's kind of like a mini group project, and it's your best chance to kind of get your team together to work collaboratively, because you're all turning this in together. It's your division of labor to figure out how to do it. So here's the thing. No lecture on Wednesday. I'm giving you class time on Wednesday to work on this. So basically, I'll see you 1 week from today, And that'll basically be our final valuation of the semester before your group projects are due. So we're going to do a dry run that involves the whole thing. Questions about that? Okay. Like I said, Chuck is doing his best to fix the computers in the lab. If you identify any others that aren't working, let me know. No lecture on Wednesday, so you have time on Wednesday to get your data for this and or work on your group project. See you guys a week from today. Good luck.
My computer,
That's why.
yeah,